Onto your markets news now. Asian markets closed mixed in today's session. Sentiment was driven by weaker U.S. labor data as a report showed a drop in job openings in the U.S. economy in the month of July. The tech sell-off also influenced market players. The Nikkei share average declined by 1.05%. The Hang Seng index was almost flat, down 0.075%. While over on mainland China, stocks actually rose with the Shanghai Composite Index up 0.14%. Over in the United States, the market ended yesterday's session mostly lower. This followed weak labor market data and continued losses on the tech stocks. The Dow Jones Industrial Average rose by 0.1%. The S&P 500 declined by 0.2%, while the tech-heavy Nasdaq ended the session down a third of a percent. Local markets are taking their cue from global markets, with the all-share index down 0.2% at 81,776 index points. The rand is trading at around 17.79 vis-a-vis the US dollar, 23.41 against the pound and 19.74 against the euro. Gold is trading at $2,514 an ounce, platinum at $926 an ounce, and Brent crude oil is at $72.98 a barrel. Mohammed Wagli is a portfolio manager at Sasfin Securities, and he joins us to break down what's happening on the markets for us. Thanks very much, Mohammed, for joining us. So after the past couple of days of sell-off on global markets, what factors may help investors to focus their minds, do you think?
Always a pleasure to be on your show, Nompu. Thank you for having me. So, yeah, I think you really hit the nail on the head a little bit earlier when you mentioned those softer job opening numbers for July. I think it gave a bit of an indication that we're expecting to see a slowdown in hiring, specifically with reference to the US in the coming months. So broadly speaking, yes, it does seem that the markets are concerned about the health of the US market, and more specifically the US labor market, and then the potential implications that could have for the rate cuts we're expecting next month. But, that being said, I've got to say that I do think, a lot of this is a bit overdone. Another factor that's perhaps worth considering, people in the Northern Hemisphere coming back from their summer holidays, perhaps in need of some funds, and, softer market data gives them that excuse to take a bit of profit, especially on companies that have done really well for them this year. And, that could also be playing a part in that sense. So if you were to actually look at sort of the earnings of these massive companies, the big tech companies you mentioned in isolation, broadly speaking, they've been really good, in my mind, haven't shown really any signs of fundamental weakness. So I think there's a lot of sort of non-company specific factors at play here. Now we've got a bit more data that's coming out tomorrow, key data, I would say, those US non-farm payroll numbers. Depending on how soft or how strong those numbers are, I think we could see a bit more choppiness. Perhaps even discourse might start surrounding the need for greater rate cuts. So I would expect, at least for the time being, to continue to see a bit more volatility here.
Yeah, volatility is the name of the game at the moment. So what's your reading of the local market in September so far? Or it's really largely moving in tandem with what's happening on global markets?
Yeah, very much the case. I would definitely say so. So really, we're tracking offshore markets. We've lost about 3% this week. I think S&P 500 probably gave up about 2.5%, and this is really sort of on the weaker sentiment that we're seeing following that softer jobs data that we're getting. I should point out that, we did get, I think, the ABSA PMI manufacturing data earlier on in the week, and that was soft, but I wouldn't attribute the weakness that we're seeing to the softness really in that respect. I think it's got a lot more to do with the weaker risk sentiment that we're seeing, across global markets, but really starting from the US and then permeating throughout the rest of the economy. So really, again, where the catalyst will be for, things to turn in this respect would be those jobs numbers coming in a bit stronger than expected. That would give investors a bit more assurance, and that could sort of turn the story in terms of the risk sentiment. So I wouldn't really say that the weakness that we're seeing locally is, inherent to our market. It's really got more to do with the American market.
Yeah. So the gold price, it lost some ground in past sessions, but now it's resurged through that $2,500 an ounce level. How much of that is a factor of the volatility and uncertainty that we're seeing right now?
Yeah, I think, it's probably quite a large extent can be attributed to that. I would say over the past year, maybe even a bit longer, much has been made of, the fact that maybe gold is becoming a bit more of a speculative play. And, while there is merit to that notion, it does seem that what we're seeing here is, in these periods of uncertainty, the safe haven asset gold still remains quite attractive. So if we continue to see this volatility, which, does seem quite likely as things stand, it does make sense that we'll probably continue to see flows into gold, probably continue to reach, sort of all-time highs, which is more or less where it is currently, But that being said, there are a few catalysts, to sort of keep an eye out for, to bear in mind, one of which is the US elections in November. We're probably going to see quite a bit of movement there, depending on what the outcome is going to be. And then needless to say, the interest rate cut narrative and, how that develops is going to play a big part in, how confident investors feel about the equity market, which then in turn will shape how they sort of feel about, gold and, safe haven assets in general. So for as long as this, let's call it lack of clarity persists, it does compute that, gold could be a big beneficiary there.
Well, let's stick with gold, but looking at a gold counter, Harmony, they came out with their annual results for the year ended June 2024. They reported revenue up 25% on the back of the average gold price rising by 16% in the period. Headline earnings per share up 132% and total gold production up 6%. On the face of it, those numbers sound great. What are your thoughts?
Very interesting. So spot on, on the face of it, the numbers look great. And I would really agree with that. I thought they were very impressive. But if you look at what's happened to their share price, they've fallen quite substantially, over about 7.5%. And, a part of me still probably struggling to make sense of this, but I do think, sort of like what I mentioned earlier in terms of sort of the US market, I do think there's an element of profit taking going on here. The share's done phenomenally well this year. So there could be an element of that, but it does seem that they did miss expectations on their dividend. Market probably didn't like that. I also think the market didn't like really the outlook sort of rising costs. But, all in all, the picture that was painted here was of a company that benefited greatly from, number one, improving the quality of their gold. And in addition to that, those elevated gold prices left them really well positioned to, yield the excellent performance that we've seen, which really the numbers did point to. So, I actually think, again, this might have been a bit overdone in terms of the performance or rather lack of performance that we've seen on the day. And, this fall might actually represent a bit of an opportunity, for those looking to get some extra exposure to Harmony. So I can't help but feel like this may have been too visceral a reaction to what, in my opinion, were really good numbers, really promising numbers, I've got to say.
Excellent. Thank you so much for your time and insights there. Mohammed Wagli, he's a portfolio manager at Sasfin Securities.